Welcome guys, this is perfect. Welcome to lesson 1. So the whole point of this mentorship is to try to simplify trading from the scratch up until the end. So let's jump right into it. So what is Forex trading? Basically, Forex trading is the exchange of currencies. You are trading one currency with another. But if I ask you what's the value of euro, obviously you're going to ask me compared to what, right? What I'm trying to say is that currencies are traded in pairs. Currencies are traded in pairs. The first currency, we call it a base, and then the second currency, we call it a quote. I just have to cover this, but these terminologies, they don't really matter in trading, right? Now, if you go to the bank and you want to change your money, obviously there will be two prices. The first price is what is called the bid. The bid is the price that the bank is willing to buy from you, and the ask is the price that the bank is willing to sell to you. Let's take for example Euro USD. If the first price is 1.2130 and the second price is 1.2130, what it means is that 1.2130 is the bid and 1.2131 is the ask. Now, according to this illustration right here, what it means is that 1 euro is equals to what? 1.2130, meaning that you are going to get how much for 1 euro? You are going to get 1.2130 USD, right? And the difference between the bid and the ask is what we call the spread. The spread basically in Forex is just the cost of doing business, right? It's the cost of doing business. Most of this stuff you understand it as I cover the platform, and if it's not making sense for now, that's okay. So now in Forex, we buy if we are anticipating in rise in price, and we sell if we are anticipating a drop in price. So if you buy and the market starts to rise, right, the more it rises, the more profit you will make. If you sell and the market starts to drop, the more it drops, the more profit you will make, right? It's that simple. Now, let's take for example Euro USD. Let's say Euro USD, CMP stands for current market price. Let's say the current market price for Euro USD is 1.2140. Forget about the spread for now. I just want to simplify it in a way that you can understand. Let us say you are a buyer at the current market price, that is 1.2140, and then price rises to 1.2180, right? The difference between these two numbers, if you can see, it's 40, right? But in the Forex market, we call it pips. So in this example, it's 40 pips. So what is a pip? A pip is a percentage in point or a price interest point. All right. So this gets us to our next question. What's the value of 1 pip, right? So it depends on the volume or lot size. It depends on the volume or lot size, and you are probably asking yourself, so what is volume then? I want to avoid the Forex jargon. For now, I just want to keep it simple. So in the Forex market, right, we have standard accounts, and for a standard account, the volume is from 0.01 to any number you want. You can put 8,000, 1,000, depending on your account balance. So if you select a volume of 0.01, you are saying that per each pip that the market is going to move in your favor, you are going to get 10 cents. So 0.1 means that you are going to get $1 per pip, right? 0.3 means that you are going to get what? $3 per pip, 550 per pip, and 100, 1,000 per pip, right? That's what it means. Now, so what determines the volume? Because if you don't have a deeper understanding, you might be saying, okay, I'll just put a volume of 500 and then I'll make $5,000 per pip and then retire, go buy a boat and a yacht. Now, what determines the volume is the risk, right? Is the risk. Before you take any trade, right, you have to know your risk, and you have to know when to get out, when are you going to take profit. So in the forex market, we use a stop loss, or in any other market. Basically, a stop loss is the value that you enter when you want to get out of the market according to your strategy if you are wrong, right? So it means the market is just going to stop you out if you are wrong. Take profit, right, is the value that you are going to enter to get out of the market if you are right, whether you are on the platform or not. So basically, that's take profit. Don't worry, I will illustrate everything on the chart. Now, back to our Euro USD example. Let's say current market price is 1.2140, meaning the market at the moment is trading at 1.2140 as an example, and you are a buyer at 1.2140, right? Let's assume you have used a volume of 0.1. So if you are a buyer, this is just an example, you want to be out of the market according to your analysis if the market drops to 1.2100 with a loss, and you want to take profit if the market goes to what, 1.2200 at a profit. So what it means is that if the market moves in your favor using a volume of 0.1 right here, you're going to get $60, because what we're simply doing is that 1.2200 minus 1.2140, right? The distance price have moved from the initial entry point, right? And if you are wrong, you are going to lose what, $40, right? Cool. I don't want to throw much stuff at you. For now, I will end it here. See you in lesson 2. So cheers.